So what I'd like to do is we're going to start with the PowerPoint, and I'm going to go through aspects of the PowerPoint, and then we'll take breaks, ask questions. We'll go through some of the exercises. This week, just to make it easy on you, we'll probably go through all the homework problems, okay? But even though we do that, I still want you to submit them because it's 20% of your grade, okay? Make sense? So what we're trying to focus on in this chapter is really getting an overall understanding what it means for, what are financial statements? What are they communicating to us? And how does it work? All of these debits and credits and balance sheet and all this different terminology is going to make sense to you when you're done with this class, or for some of that matter with today. So we're going to start by talking about various types of entities businesses have, and then we're going to talk about what type of people use financial statements, what is it they're looking for, and then we're going to understand certain types of key elements of financial statements: assets, liabilities, and equity, okay? So basically, businesses operate, and they operate all over the place. Most businesses in the United States are sole proprietors. Now, that doesn't mean they're big, but most businesses that are operating, the majority of them operate as a sole proprietorship. Corporations take up by far the largest amount of business as far as dollar value and activity. But most organizations start as a sole proprietor because it's so easy. You just say, I'm going into business. I know when I started doing accounting work back in the 80s, I started as a sole proprietorship, then I moved to a partnership, and now I'm a corporation. But it's easy to just start as a sole proprietor. It's easy to start. One person runs it and controls it, and the income or the losses flow back to your personal return. So it's really nice and easy. Partnerships, easy to start, but partnerships are more than one person. Okay, so it's two or more people. What's the benefit? Well, tax benefits, they flow back to your personal return also, the income taxes. But instead of one head, you have two heads to help make decisions. Okay? That's a benefit. A negative with it, instead of one person screwing up, you've got two people that could screw up, and then you become liable for what they've done. Corporations are what Target is, what Best Buy is. Most entities you see out there that we know of are going to be corporations. The beauty of a corporation is it never dies. When you've got a sole proprietor and I die, well, guess what? The business ends. But with a corporation, it's going to continue on even though some primary people die, because the corporation the shares can be transferred easily. It's easy to get money. When I want to start a business, I've just got the ability to raise funds based on my economic situation. So if I need to go out and find $1 million, I'm going to have a tough time on my own doing it. But with a corporation, you're able to receive more equity or cash via the selling of stock shares. So that's the beauty of a corporation. The other beauty is, let's say something happens in the corporation and they have a big lawsuit. Well, you're only limited to the amount of money you have in that company. They can't go and sue you above and beyond as a stockholder or shareholder what your worth is in the company. Whereas with a sole proprietor, I had a lawsuit, let's say 20 some years ago, and they were trying to sue me for something that I did within the business. They could come back after my personal assets. They just can't, they're not just limited to my assets in a business when you're a sole proprietor. They can come back and sue me, and I'm personally liable for my actions. So there's positives and negatives with all forms of these business entities. In choosing an organizational form let's pretend we're going to do this outdoor guide. Anyone into fishing or hunting or anything? Okay, you're going to be an outdoor guide and you want to take people on adventures. You should consider the pros and cons of each. Identify each of the following organizational characteristics with the organizational form or forms with which it is associated. So we're dealing with a corporation. I'm just giving you the options. We're dealing with a corporation. We're dealing with a partnership. And we're dealing with the sole proprietor. Okay? So, which one is the easiest to raise funds? Is it a corporation, a proprietorship, or a partnership? Corporation. Which is easy to establish? Sole proprietor and partnership. Which has no personal legal liability? Corporation. Tax advantages? Partnership and sole. Just because corporations get taxed at a higher level, and we'll talk about that, and there's something called double taxation. And easy to transfer ownership is a corporation because you just can sell your stock and get out of it, okay? Whereas to transfer ownership, I need to find someone who's going to buy it. You know, you got to find just the right person who's willing to take it on. There's a lot more involved than just having shares of Target and you can get out of it. So those are some understanding of businesses and how they start. So we've got businesses. Let's think of General Mills. General Mills is a huge company here located in Minnesota, and various people want information about General Mills, or Target for that matter. Boy, a lot of people want information about Target, and they're not doing real well right now. You guys know about the credit card scam? They're hurting. Their profits are down. The CEO's left. I think this backlash is going to go on for a little bit until Walmart gets caught doing something. Then it will get better. But there are all kinds of people who are interested in information on businesses. Internal users are those people within the company, inside the company. That's going to be what managerial accounting is going to talk about next semester. You guys take that. Marketing, like for example, what price should Apple charge for an iPod to maximize the company's net income? Well, the marketing company of Apple really needs to see what their competition is, the unique differences for their tablet versus another tablet or the iPod or iPad. And so their need for information is going to be really a lot different from other users. Management, which line is the most profitable? Should maybe they eliminate certain product lines? Microsoft stockholders, is there enough cash so dividends can be paid out? So they're going to need different types of information to gather that. They're going to want to know their cash flows for normal operating expenses and then planned expenses to see if there's money left over to pay stockholders. HR, what happens? General Motors is going on strike again, so they want raises. Do they have the ability to pay raises? Where's that money going to come from? Are they going to increase the car sales prices? How's that going to work? How do they compare with Toyota, who's not in the union? So here are different sources of people who inside the company need information, and they get that information from financial statements internally. But when we're dealing with, in this class, relates to external users, people outside the organization that want information about a company. So for example, if we want to invest in a company, do we just say, boy, that company, I like the way they look, and boy, I just like Best Buy because I buy my TVs there, so I'm going to invest in Best Buy. No. Hopefully we use other types of information to make informed decisions for where we're going to invest our money. So investors want financial statements to give them information as to the profitability of a company, or what's called the liquidity of a company. All these things we'll talk about. Creditors. Well, companies are borrowing money from banks to continue for expansion or various purposes. Those banks or bondholders would want information to see if they even want to take that risk of financing items for a company. Or here's another one. Disney compare in size and profitability to Time Warner. Let's say we look at Delta and we look at American Airlines. If we're interested in investing in one, we might compare within the airline sector or airline industry other types of companies similar to it to see how they compare to their competition or competitors. So all kinds of ways that outside users, external users, get information on a company. Okay, a lot of these I'm really not going to spend a lot of time on because there's just so much to cover. But you guys can go back and look at some of those. If I don't talk about it in class, you're not going to see it on a quiz, okay? So even if I discuss something, if I tell you to make an effort to go overkill and look at something, chances are you'll see that again on a quiz. Ethics. One thing you're going to notice in accounting classes is we talk about ethics in every single class we teach. I'm sure that's true of a lot of business courses too. And ethics are discussed just because there's been so much wrongdoing with professionals within organizations that now we try to, stuff ethics down your throat to help you understand what you should and should not do. Sometimes the shoulds and what really happens in the real world is unfortunately different, but there have been a lot of problems that's happened. Enron started it where their company financial statements were just a big joke. They were total lies. Same with WorldCom. You guys have heard of Petters, Denny Hecker. Who else has been around here that's happened just recently? Well, and who's the guy out in the Empire in New York City? Madoff. I mean, it's not going to quit, and they're going to continue to be exposed of wrongdoing. So there's been a lot of fraudulent activity that's happened in regards to financial statements and activity. So because of all this, because what happens is investors end up losing a lot of money. Investors lose money, banks lose money, but who makes it big? Who makes the money everyone else is losing? The greedy CFO or CEO, those that are perpetrating the fraud. So because of this, the Congress has come out with a lot of more stringent rules called Sarbanes-Oxley Act, or SOX. You're going to probably see this again, guys. The Sarbanes-Oxley Act was passed as a result of a lot of companies doing unscrupulous acts. And so guidelines have come out in regards to financial statements and who's responsible or liable for accurate financial statements and what happens when people intentionally misstate, intentional disregard for the truth or fraud. What happens, who's responsible for those? And so basically, the most important piece to know, financial statements for external users are basically for the public. And so we need to be held to a high standard because it's not as though it's just the employees of a company that are using this information. It's external users that are using this information. So we need to be held to a high standard, and so does the company that's submitting those financial statements, that they're accurate. So SOX, as a result of what's happened within the industry, has created strict guidelines for the CEO and CFO and the board of directors. Now, there are, I'm not going to talk about ethical dilemmas here just because there's so many different things we can discuss, but ethics has become an important issue in accounting because we can misrepresent companies. And you'll understand as we go through this, I'll give you some examples of how things have been misrepresented. And people are relying on making decisions based on those financial statements. Okay, guys, you would know this because we didn't go into detail talking about SOX yet, but basically, which of the following did not result from the Sarbanes-Oxley Act? Well, top management now has to certify that the financial statements are accurate. There are penalties for being fraudulent. I mean, fraudulent gets you in jail, okay? Independence of auditors have increased because those CPA firms that audit these financial statements are held to higher standards, and as a result of that, there are guidelines in place so there can't be an appearance of collusion or that they're buddies in appearance and in fact. But tax rates of corporations have not gone up as a result of Sarbanes-Oxley. Sarbanes-Oxley, or we call it SOX, is mainly about new penalties, rules, procedures in place as to making sure those financial statements are accurate. So it does not include tax rates have risen as a result of that. Any questions yet? Am I going too fast? Speed it up? Okay, I can speed it up, someone said. All businesses are involved in 3 types of activity. So basically, when we deal with a business, we need to get money to build a business. So financing activities are those activities that help generate money and bring in money for us to buy capital assets. Investing, sometimes we might have money on hand that we can invest just so we can be resourceful and wise of the monies we have currently available. But the real reason businesses operate are for them to provide either a service or a product or some type of activity. So if we think of even Red Cross, granted, Red Cross is not a for-profit business, but it still is a business that helps the community at large in, for the most part, providing blood services, okay? And help for people in need. CPA firms provide a service to either for financial purposes or, in my case, just to get someone's taxes done. It's a service. 3M. What do? They do a lot, but what are one of the biggest pieces that 3M does? Minnesota Mining and Manufacturing. They're a manufacturing company. General Mills, manufacturing. Delta Airlines, a service industry. So most businesses, well, all of them are in place to provide an operation of some type, be it service or manufacturing. And what we do as accountants is create an accounting system that keeps track of all these various activities. So these financial statements are our method of communicating the results of financial activities. Okay, guys, financing activities. What are things related to financing activities? Borrowing money. Too bad money does not grow on trees, but it doesn't. So we've got to go out there and borrow money so we can create new lines within a company, new capital assets, expand to other countries. So we need to go borrow money. When we borrow money, just like with ourselves, how many of you, well, you don't have to answer, but you're in school. If you don't have the funds within your cash bank account to pay for school, a lot of you have borrowed money via student loans to go to school. I own a home. I didn't have the means to have the cash for the entire home, so we've borrowed money in the form of a mortgage to own our home. So borrowing money, and that mortgage I have is a liability. Your student loans are a liability. It's something you owe, right? Make sense? So the creditors are the student loan, Nelnet, or Wells Fargo, who might have your student loan note, or Wells Fargo for a mortgage, they're the creditor. They're the people I need to pay back. You need to pay back. So know that amounts owed are called liabilities, and the people that you owe are the creditors. Credit cards, creditors. Get it? Any questions on this? Does this make sense? Is this fairly straightforward? Because most of you have worked, been in the world, so you get this. It's harder sometimes when you're talking to 17-year-olds and they've never experienced even a student loan. So liabilities are those things we owe. And there's all kinds of liabilities out there. Student loans are a form of a liability. Mortgages are a form of a liability. But for our terms right now, we're going to talk about things called notes payable and bonds payable, are types of liabilities. A note payable is usually something you're not going to be able to pay off within the current year. My mortgage is a note payable. Guess why? Because it's going to take me 30 years to pay it off. Bonds payable are another source of financing that we'll talk about. Another way companies get money is selling shares of stock. So instead of having to go to a bank as a creditor, we go and we try to recruit stockholders to help bring money into the company. And when stockholders have certificates of stock because they own a piece of the company, they get rewarded by dividends. Do any of you guys have stock? If you do have stock, a lot of times you're given dividends, like a return on the money that you've invested within a company. A lot of times you sell it and hopefully that share price has gone up in value. But certain companies, like utility companies, usually don't fluctuate a lot in value, but they receive dividends so the stockholders can get a piece of the pie. Now, those are financing activities, ways in which they get money in so they can create their business. Investing activities are other things. When you have a company, you've got to invest in a variety of things. You might have to have buildings. Augsburg, it's a nonprofit or a private community college, but Augsburg had to create buildings. They've got to have some technology, okay? Those are assets, property, plant, and equipment that they needed money for to be able to have students come and attend school. So these assets, such as this building, such as these desks, such as the technology here, the computers, those are all called assets. Those are items or resources that a company owns, okay? So they own assets. Augsburg owns this building. Now there might be a loan on it, but this particular structure is owned by Augsburg. And then sometimes there may be monies available that are going to be used down the road, but they're available now. And so Augsburg may invest some of those monies for a short-term purpose to make money. So if I've got extra money sitting around, which very seldom happens, I'm going to want to invest that money, such as retirement or stock, so I get a return on my money, okay? So these are various types of investing activities that companies do. Operating activities are really the big bulk of what we're going to pay attention to. The operating activities are why that business is in existence. Once a business has the assets it needs, it begins making money by either selling products or providing services, and that money that they make are going to be called revenues. If there's products that they're going to be selling, there's inventory, which is also a resource or an asset. And then there's accounts receivable. So let's just say that I am providing a service, and after I've provided that service, you need to give me money as a result of that service I've provided. And so receivables are the right to collect money from a customer based on a sale, be it selling of goods or performing services. It's really important that you know investing, financing, and operating activities to understand what the differences are and why, okay? Financing activities help raise money. Investing activities are purposes to get the business going and assets that might be utilized within a business. But ultimately, all of that is for the purpose of operating, okay? For the purpose of why a company's in existence. Now, there's more items associated with operating. We've got revenues, that's the money coming in. But expenses are all the costs that we need to consume in order to either sell our product or perform our service or provide the service. So sometimes this can be selling goods. So we choose to sell computers. Once I purchase a computer, it becomes a cost of goods sold. I think I spent $1,400 for this computer. It's really cool, guys. It's a solid state. So like I can just turn it on like an iPod pad, you know, when it's ready. And it's real thin, and it's even. I'll be like, you know, Vanna White. It's even, you guys probably don't care. I know because it's not an Apple. But it's even a touch thing. But I can't figure out Apple, what I say, Windows 8. If anyone knows Windows 8, I would love to talk to you because I lose things in here. Anyway, never mind, you didn't need to know that. But when I went and purchased this computer from Dell and gave them $1,400, that $1,400 consisted of revenue. Then I received this computer, which was in their inventory, but then I received it now, so it's a cost of goods sold. That probably was their cost, and it was maybe $1,000, you think? You think they make that kind of profit on it?
On a computer?
Uh-huh. $400?
Probably go on like 400 or something. Well, wait, Dell?
Dell.
I guess it really depends on how big their manufacturing is, because cost goes down over time as you increase.
Right. Well, and Dell computers really, I don't know, but let's just say it cost them $1,000 to make this computer. Then that's the cost of goods of what it costs them to make this product. Then they have other expenses in making that product. The people who are selling it on the salespeople on the phone, the marketing to get Dell's name out and their latest and greatest item. You've got the administration that does the human resources, the payroll, the executive branch that helps help Dell decide which avenue they're going to go into. So to make the revenues, you have to fork out expenses to make revenues, right? Then there are liabilities that can happen as a result of having expenses. I may choose to, my CPA practice, perfect example. I have to pay utilities. Well, that's an expense when it comes to me, the utilities, the water, the trash, but I may not pay that right away. And so I might have a liability, something I owe somebody on my books until I do pay them. Certain companies have to pay sales tax. So when I go and purchase a computer from Dell, they had to collect 6.875% sales tax. And then in turn, they don't get to keep that money, do they? They have to pay it to the state of Minnesota or wherever they're in operation. So after your revenue minus all your expenses, hopefully you end up with net income. Net income is going to happen if your revenues are greater than your expenses. But what happens if your expenses are greater than your revenue? Apart from you're going to go out of business soon. You got a net loss, okay? We want net income because we want to live on this money. We're working hard to receive a benefit. When revenues exceed expenses, we've got a net income. So let's look at some of these various items and let's kind of talk about assets. Assets are items that we own that are resources that we own that are going to provide a benefit for us for over a year. Liabilities are those amounts we owe. We need to pay back. Stock is equity or worth in a company, ownership in a company. Revenues are monies we earn. And what are expenses? Cost to do business. So, what's the cost of running property? Let's say I leased my office space and I pay rent. Do I own that building if I'm paying rent? No, it's a cost I need, so it's going to be an expense. I go and purchase a truck. Do I own that truck? If I purchase it, I own it. So a truck is a resource that we're going to derive benefits from for over a year. So that's an asset. Notes payable. What is a notes payable? Is that something we owe somebody? Whenever you see the word payable, you owe them. Okay? That's a liability. Issuance of ownership shares. When you own shares of a company, that's going to be common stock. Okay? It's not an expense. You own a piece of that company, so you've got some equity in that company. Amounts earned from providing services. Earnings are equivalent to revenue. And then amounts owed to suppliers is also a liability. You owe it. Now, if we had the word amounts paid to suppliers, that would be an expense, okay? Paid to suppliers. Suppliers meaning a supply. So it's not going to last us more than a year. The big key to know is an asset is a benefit or a resource that's generally going to last longer than a year. Such as, is this building going to last us longer than a year? Yes, it's an asset. Is my computer going to last me longer than a year? That's debatable, but they're supposed to. How about these desks? Are these going to last longer than a year? Then they're an asset. How about office supplies? No, let me not say office supplies. What about the air conditioning in here? Is this going to last us, this air conditioning that's pumping in, is this going to last us for another year? It's going to be gone as I breathe the air. It's an expense. It's a cost of having us in this classroom to teach a course. It's an expense in providing a course for college, okay? So Augsburg provides a service, a college education. They receive revenues through your tuition, and there are various expenses that are going to happen as a result of that. They need to pay me a salary to teach. The utilities in here are an expense. We're not going to have a benefit of these utilities because as it gets pumped in, it's going away. Make sense? Any questions? Yes, no? How are you guys doing? Okay, so basically, these financial statements we're talking about, there are 4 different financial statements we're going to talk about in this class. 2 big ones that you should know about are the income statement and the balance sheet. How many of you guys have heard of an income statement? An income statement has 2, we'll talk about that in a minute. Income statement, balance sheet are the 2 really common ones you've heard of. And then we're going to talk about 2 more, the retained earnings statement, which is basically the equity section, and then something called the statement of cash flows. You want to have, guys, you know what? You have to have money to make money. You know what I'm saying? You need money to make money because even though you might have a great idea, if you don't pay your bills, are you going to stay in business? You're not going to stay in business. So know the 4 primary financial statements: the income statement, the retained earnings statement, the balance sheet, and the statement of cash flows. Those are the 4 financial statements we're going to talk about in this class. Okay? Here's a question for you. Net income will result during a time period when assets exceed liabilities. What's an asset? A benefit or a resource we receive a benefit from, right? Assets exceed liabilities. What's a liability? Something we owe, right? Is that net income? No. Assets, a benefit, a resource that gives us a benefit, exceed revenues? No. Expenses exceed revenues? That would be net loss. Or revenues exceed expenses? Revenues exceeding expenses is net income. The income statement only shows revenues and expenses. Revenues minus expenses will either equal net income or net loss. Okay? This shows us an income statement. This income statement starts out by listing the name of the company, and it tells us it's an income statement. And it tells us for the month ended October 31st, 2014. So it's telling us, this income statement is telling us everything that happened over a certain period of time. So from October 1st to October 31st, throughout those 31 days, revenues came in of $10,600. Okay? During this whole month, monies or revenues came in of $10,600. And there were all these expenses. We had salary expense of $5,200, rent expense of $900. We used up supplies, paper products and toner cartridges and who knows what, $1,500. There's something called depreciation we'll talk about in a little bit, called $40. Interest expense, we owe money to creditors. They don't just give us the money for free. Can you believe our looks don't pay for that money? We have to give them interest. So in order for them to lend us money, we have to pay something above and beyond back to them. And then insurance. Insurance for having a business, insurance for what if we trip and fall in here? We've got to pay an insurance expense. So our revenues minus all those expenses show a net income of $2,860. That's because our revenues were greater than our expenses, right? Does that make sense? This is really an important PowerPoint for you guys to look at. An income statement reports revenues and expenses for a period of time. Know that. It's not just for a day. Well, even if it's for a day, it's a period of time. But generally, it's for a year or a month or a quarter. Okay? And we know our net income is where our revenues are greater than our expenses. And our net loss is not what we want to have. Our expenses are greater than our revenues. Okay, did you just see how I ignored this predicting future net income? If I don't even talk about it, do you need to know it? No, you don't. So what happens with this income statement is when we have a net income, which is what we want to have, that $2,800 revenue that happened during the month of October is going to flow over to what's called our retained earnings statement. So what that means is that net income now becomes part of the earnings or the equity of a company. So that $2,800 gets to be utilized by those people who own the company and could either be given away in dividends or utilized. So know that whatever that net income is gets tied back into the retained earnings section of the financial statements. You'll understand how they all tie together ultimately, but that money flows back to the retained earnings section. If it's a loss, a net loss, that also flows back to the retained earnings sections, instead of adding it, what would we have to do? Subtract it, because we're losing money. But in this scenario, our net income gets added back over to our retained earnings section, and we come up with an ending balance in what's called our retained earnings based on what we've added or what we've subtracted within net income. Just hang in there with me, because it will all make sense down the road. So this retained earnings section here starts with a balance. Let's say we started business on October 1st. We started with 0. But in 1 month's time, we made $2,860. So we added that to our retained earnings. But we also gave away $500 in dividends. In this case, let's say we gave $500 to various shareholders for sticking with us. That's also an item in the retained earnings. It's not an expense. It's a portion of retained earnings that gets reduced from our net income to come up with a final or an ending balance of retained earnings. Hang in there with me, because it all will come together here. So you know that retained earnings I was telling you about, or that stockholders' equity section or statement? When we look at a balance sheet, do you see how this retained earnings section here, this 2360, do you see how it gets plugged in to our stockholders' equity section of the balance sheet? So know that a balance sheet shows us our total assets. Do you see here it says here assets, cash? Those are resources that provide a benefit. Accounts receivable, those are monies we're going to get that provide a benefit or future collection of service revenue. Supplies are those monies, assets sitting available for us to use. All of our assets in this illustration here are $21,910. Well, assets are going to the top section of a balance sheet. Look what else we have. We have liabilities. What's a liability again? Things we owe. Monies we owe. We have notes payable to banks, accounts payable to probably various suppliers. We've got some unearned service revenues that we'll talk about down the road. Salaries we owe money to employees. Interest we owe to the bank. So here we have all these liabilities of $95.50. But our balance sheet doesn't just show assets and doesn't just show liabilities, it also shows this equity, stockholders' equity section. And the stockholders' equity section is a series of the common stock we have in the company, that equity section, and then we add to that equity section our balance on our retained earnings. This is how everything balances, because our assets are going to always equal what our liabilities are, along with our stockholders' equity. Do you see how our 21,910 equals down here 21,910? And the reason it works so well is that income that flows over from the income statement flows through this retained earnings section to balance. Okay? So again, I'm giving you a lot of information all at once, but I want you to understand that the income statement is about revenues minus expenses, giving you net income. But the balance sheet, we're going to call it a snapshot. The balance sheet is a snapshot on one specific time. This on October 31st is a snapshot of the company's assets, a company's liabilities, and equity. Now, the reason it's a snapshot, on December 31st, I might have $5,000 in my checking account because I haven't paid any bills yet. Then on January 1st, guess what my new balance could be? $2. Do you see how it's a snapshot because it's always changing? Okay? That's why we call a balance sheet a snapshot. So, reports assets and claims to assets at a specific point in time. It's a snapshot, is the best way to say it. It's not over a period of time, it's a point in time. And the accounting equation we're going to get to is this balance sheet. Assets, or the 21,910, equal everything in liabilities, or 9,550, plus our stockholders' equity of 12,360. Assets will always equal liabilities plus owner's equity. I'm going to